Growth stocks are living up to their name, much to the frustration of investors who aim to buy cheap and sell high by sticking to so-called value shares instead. Growth and value are only loosely defined classes of shares, but broadly speaking, value shares have low price relative to book value and earnings, along with a high dividend yield, while growth stocks are those with rapidly rising profits and sales, which naturally enough tend to be more expensive. Over long periods of time, value shares have outperformed, as Gene Fama and Ken French documented in 1992. But not this time round. Since the Great Recession started, investors would have been much better off buying high than low, as companies seen to have decent growth prospects have far outperformed cheaper shares seen to be rather duller. Now, if we look at the MSCI growth and value indexes for the US, back in the 1990s cycle, shares that were defined as growth stocks soared as the dot-com and biotech bubbles lifted them up before they plummeted back to earth when the bubbles popped. But in the 2000s cycle, which I've started on this chart here, 2004, value returned to its normal position, beating growth, value being here in blue and growth in red. It beat growth as the weaker companies were lifted by global economic expansion and just did better anyway. But after the global financial crisis, growth stocks have led the way, with the index hitting new peaks this week. You can see that there, even as value shares have gone nowhere all year. Now, one possible explanation is the rising belief in secular stagnation. If the economy is going to be permanently slower than in the past, then the shares which profit from expansion, the cyclicals, look rather less appealing, since there isn't any of that expansion to provide the profits. Rather than buying the sort of cyclical companies like car makers, investors who want a decent chance of rising profits from their investments need to look for companies which can expand no matter what the economic backdrop is. And that means new technology stocks in particular and growth stocks in general. Now, it's hard to define when this has gone too far and when growth stocks are just too expensive. One way to think about it is to look at the most extreme segment of growth stocks, those priced purely on hope, the biotech companies, which frequently have little to no earnings at all. To see the extent to which biotech is really just the ultimate version of growth stocks, I've put on here two lines showing the ratio of growth to value in the US, that's the red line over on the left axis, and on the right axis here in blue we've got the ratio of biotech stocks to the S&P 500. When growth stocks win, biotechs win. When they underperform, so do biotechs. Now, of course, the size of the outperformance is quite different. Betting on biotechs can lead to really extraordinary returns when it goes well, or much bigger losses when it goes badly. But the direction of biotech and growth is almost always the same. Now, the reason to look at biotechs is for their valuation. Of course, valuation can always get more extreme, especially when central banks are pumping up asset prices. But the Nasdaq Biotech Index currently priced at 9 times book value, 50 times trailing cash flow and 10 times sales. And even 2 years ahead, it's expected by analysts to have a dividend that amounts to just 0.35% of their current price. Now compare that with the 3% dividend expected this year from US value stocks, which trade at twice book value on average. And it's quite clear that biotech is priced for an extremely bright future, to put it mildly. Now, if these valuations make you think that biotech companies must have identified the hope gene, then growth stocks really aren't for you either, because a drop in biotech is likely to be mirrored by underperformance of growth as well, just as happened in the growth crash early last year, which you can see there.